Okay, so you've probably heard the term SPAC a lot of late. It's the most recent IPO craze to hit Wall Street, and a lot of reputable companies are going public this way. But what even is a SPAC, and why are most companies and investors eager to hop on the trend? Let's break it down. SPAC is an acronym for Special Purpose Acquisition Company, which is basically a publicly traded company that has no operations or no assets. It has just one business objective: to purchase another company. So the SPAC that goes public to raise money is not actually a company itself, but the promise of one in the future. Usually a SPAC is created by institutional investors or Wall Street professionals, and even industry leaders are getting in on the action of late. When they launch a SPAC, they don't have a particular target in mind, but normally a particular industry. That's why it's often referred to as a blank check company. The people buying into the IPO don't know what the target company is going to be, but they do trust the sponsors of the SPAC based on their record of success. Once the IPO raises capital, that money goes into an interest-bearing trust until the SPAC's founders can find a private company that's interested in going public this way. Sponsors normally have about 2 years to find a suitable deal and get it approved by shareholders. If they don't, the SPAC is liquidated and the investors get their money back with interest. So now that we've covered what a SPAC is, why are they suddenly so popular when they've been around for decades? Well, the simple answer is that influential investors like Bill Ackman have recently been pursuing SPACs as an IPO path with good results. And further, they've become popular with the market volatility that's been caused by the pandemic. On the company side, a SPAC allows it to go public and get cash quicker than it would in a traditional IPO. That process involves building a prospectus over months, going on a roadshow, and building a full book of institutional investors. SPACs also allow companies to provide forward-looking projections, which most companies don't do in a traditional IPO due to the liability risk. On the investor side, a SPAC may at first seem kind of risky because you don't know what the target company is going to be. But it is on the cheaper side at $10 a share, and it allows you to bet on the instincts of a successful investor or leader, which some people don't see as risky. Make sure you stay on the lookout for SPAC IPOs. There are a lot slated for this year, and how they fare will determine if this trend has staying power.